So, good evening, everyone. How's your Saturday going? So, we have done till SA 530. We've done till SA 530, and now we'll start with SA 540. We'll try to finish off SA 540 and 550, two big standard, two important standard. And to start with this attempt, two questions came of 5 marks. That means SA 540 weightage was around 9 to 10 marks. 10 marks straight away from only and only from SA 540. See, and the questions that came, both the questions that came for SA 540 in this attempt, both were not, I would say, new, but rather which were not yet asked till now. So one question was there which was asked in RTP May 19, and the other question which was not asked in anywhere, not anywhere. And in the videos, in the revision videos also, if you could see, if you can go what I've uploaded in the YouTube also, I have specifically focused on these questions which have not yet asked. I told also that yes, these are important. This question was asked in RTP May 19, and this can come. It is only a matter of time when this will suddenly pop up in the exam. And one more question was this: inquiries about the transaction, inquiries about management, about changes in the circumstances. So both the questions were sort of a new question, you can say, from SA 540. But however, we were already prepared. We were already prepared because we knew that okay, fine. The questions that are already been asked from SA 540 are three or four questions that are repetitively asked, but they can surely ask new questions as well. And as they have given both the questions, one question was from RTP May 19 only, and the other question was from this, and both the question was specifically laid emphasis. Apart from this, what I wanted to convey was again that now also you can expect that yes, there will be new questions only that will be asked from SA 540. If you consider the questions or the consider the content what is given in the SA 540, you will find that there are lot many things which are being left till now not yet asked, and are given in annexures containing 8, 10, 9, 10, 11, 12 points. So they can, especially for 5 marks, they can ask all these questions as well. So what I have done is I have just included 3 4 questions according to me, which according to me is important, which has not yet been asked but is important question, not yet asked on any other platform, ICI, RTP, MTP, or be it exam as well, not yet asked, but according to me could be asked. So what I'll do, I'll let you to read these concepts or read these annexures in SA 540 as well as in SA 550 as well. So that if they at all comes, if at all it comes, then you are at least aware about what was there in it, at what was there in it. Not that we have to lay special emphasis on these topics, these both 3 topics, but yeah, these are out of 10, 11, 12, 13 topics which I feel that okay, can come or is important. We are still not covering the entire 100% SA 540. If you can see, SA 540 content, it's already 30 40 pages bare standard, so we can't cover each and every topic, right? This I've also told in the beginning as well, that whatever we are covering, we are sure that okay, fine, that will come from here, but let's be prepared that yes, out of 4 or 5 questions that is asked from standards on audit, one question can be out of the box. Since past two attempt, it is not being the case that whatever is come is from our book only. Don't worry, but yes, be prepared that it can be out of the box, because still we are not covering the 100% of the bare standard, 100% of the bare annexure. That is just a disclaimer to give it you. And for that matter, you should always go through these 2 3 additional topics which I have given in the last as well. Just go through them and just try to understand what they are trying to say, and if at all any question comes, what can be the question that can be asked from these 2 topics. Just try to guess that. Okay. So now we'll start with SA 540. To give you a background, I've already given the importance of this standard SA 540. 2 questions came. Now what we have to do in here is auditing and accounting estimate. So estimate could be, what they have done is divided into 2 parts. One is fair value accounting estimate, and one is other than fair value accounting estimates. One is fair value accounting estimate, and one is other than fair value accounting estimate. Both the accounting estimate we have to deal with them and accordingly audit them as well. And in the doing so, what additional audit consideration are we going to see? So in the accounting estimate specifically, don't you feel that there will be a risk of material misstatement more. There will be more of risk of material misstatement in the case of account estimate balances like provision for doubtful debt or any other sort of provisioning, or any other balance which is getting its value from the fair value. So you are obtaining the fair value and then recording or recognizing in the financial statement. So all these estimates that you are taking, accounting estimate, what do you think the risk of material misstatement will be, more or less? ROMM in the financial statement will be more or less? Bulbulo,
More.
more, right? So why do you think so it will be more worst? Why but? Yeah.
Sir, if there is any differences, like in the, suppose if there is any differences in the entry, uh, or else if there is any differences in the balance sheet, people they can use it. They can use that differential amount in this accounting estimate. Suppose we assume that the bad debts is 1 lakh, and we have suspense account of 20,000. So instead of providing for 1 lakh for bad debts, we can provide 1,20,000. So that different, there's a misstatement over there.
So you are saying that you can manipulate the financial statement easily using the accounting estimates, because
Yeah.
the estimate might go wrong. Estimate might go wrong, doesn't matter then Lakshmi. Estimates are bound to go wrong. You can't imagine, like you can't forecast everything, right? We are not God. We are doing estimate based on the circumstances, situations right now, right? So you can't say that estimates what we have made and the next year actually bad debts happen suppose 2%, but we have made estimate for 5%. So the actual versus estimate variance is a misstatement. No, it is not so. They have specifically clarified this in the standard as well, that any variance between estimate and versus actual against the estimate, it's not a misstatement. It's not a misstatement, right? We can't question on that, because that estimate was, you made estimate on the circumstances or prevailing conditions that were there during that period, right? But what Avijay is saying is that you can manipulate the financial statement so that there can be more of risk of material misstatement, or I could simply say, not in those lines what Vijay is trying to say, management manipulation. Right now management also might not be willing to manipulate, however there is a significant degree of uncertainty involved, right? So because of this uncertainty, you can play with the numbers, right? Vijay is saying you can, or management or whatever they are trying to say, if they want to show optimistic figures, they can reduce the provisions. If they want to show reduced profitability, they can increase the provisions. So that is what they are trying to say, that degree of uncertainty is more, uncertainty involved is more, and because of that ROMM is impacted, ROMM of the financial statement is impacted. Okay. So see, accounting estimate may be defined as an approximation of monetary amount in the absence of a precise means of measurement. The term is used for amount measured at fair value where there is estimation uncertainty. Because of the degree of estimation uncertainty which is involved in the AE accounting estimate balance, it affects the ROMM of the accounting estimates. It affects the ROMM of the accounting estimates. A difference between the outcome, see Dhanlakshmi, a difference between the outcome of an accounting estimate and amount originally recognized in the FS. So outcome of the accounting estimate, that means suppose bad debts actually turned out to be 1%, but you recognize provision for bad debts as 4%, does not necessarily represent a misstatement, does not represent misstatement. It can be if management is involved in such kind of manipulation, deliberately they have charged higher PFDD or whatever be the case, but that does not mean that it is not according to the circumstances that prevail during that period. It could be so, right? So to give you an example, all banks, do you remember high risk is provided provision based on estimate, right? Correct, Dhanlakshmi? It's high risky because of, again, degree of high estimation uncertainty, right? So what I was trying to say is, in the third point I was giving you an example in the cases of banks. If you remember, in the case in during COVID period, there was a guideline given by the RBI on moratorium. If you remember moratorium, right? So restructured accounts were there. Restructured account means what? Accounts were held as moratorium. Those who were not paying interest or principal, those were transferred to restructured account, and that restructured account will not be classified as NPA, that they have clarified in the by the RBI. However, they could be classified as an NPA as well if the bank wants to, but they can classify these accounts not as NPA but rather restructured or reconstruction accounts, so that their NPA figures are not exaggerated or their asset quality is not deteriorated of the bank, which is also not the case, right? Because these are the government guidelines only, what they have provided, that yes, you can opt for moratorium if you want. So that does not mean he is non-performing asset now. He is performing, but he has opted for the moratorium. So based on that, on restructured account, they provided additional 10% of the provisions. So generally, provision on standard asset is how much? 0.25%, 0.5%. That according to as per RBI guidelines on banks. That will also see in NBFC chapter as well. How much provisioning to be done in standard assets, on doubtful asset, right? On substandard asset. So that we'll see. But they provided restructured asset guideline was there. RBI they told that minimum 10% provision has to be provided for restructured account, and banks can also provide for additional if they want to. So suppose bank thought that yes, this structured account will slip into NPS as well, or will slippages will be more in the case of non repayment of the loans when the COVID this restrictions will lift up, right? So they didn't feel that okay, the economic environment might not grow suddenly as happened in the our Indian scenario. But that was again their estimation during that period when the COVID was happening, during the moratorium when the people were opting. But actually, what uh, are circumstances, the outcome of what restructure or the outcome of the economic improvement was that restructured account were there, they were able to make the repayment and were should be moved to standard account also. So the provision that they made excess doesn't mean that bad debts did not happen actually in those terms, and therefore that is a misstatement. No, that is because of the misstatement, that is because of the conditions that prevailed during that period, because of which we made such huge provisions. So during this period they will not make that much provisions, they will not make that much provisioning or impairment expense could be lower for the banks during this period because they are adequately already provisioned. Clear? So we'll now see what example other than fair value accounting estimate, an example relating to fair value accounting estimate. Other than fair value accounting estimate and fair value accounting estimate, that only I told you accounting estimate could be both. It is fair value as well as other than fair value. So fair value accounting estimate, you can relate it to whatever you can say, um, any assets that you recognize or any financial assets or financial liabilities that you recognize, you generally recognize at its fair value. Whenever you are asked to recognize it at its fair value, then definitely it's a fair value accounting estimate only, because you are determining fair value from some source, from some source of information you are getting the fair value. So do you remember index 113? Anyone? Index 113, it is on fair value only. Fair value. So wherever index requires you to compute fair value, either they will give specifically the method in the specific standard itself, or if not given, then you can refer what index 113. Oh, sorry. Yeah, index 113 only. Correct. So index 113 fair value accounting estimates, or sorry, fair value. So they give specific guidelines on fair value measurement, correct, Sony? So Index provides you that yes, you can calculate fair value according to this methodology, and then accordingly recognize that asset or liability in those fair value only. So this fair value, whenever you are required, suppose embedded derivatives. Embedded derivative is a complex financial instrument. Embedded means what? It is embedded in that contract itself. So suppose I am contracting with Avija and trying to say her that okay, I'll sell this thing to you, but I will give you an option to give it back to me again. So there is an option involved in the contract. Option, and if there is an option, then that is a derivative contract as well, and there is involvement of embedded derivative. And this kind of complex derivative, complex financial instruments, we are told in India's that India's 109 in the financial instruments India's, we are told that okay, you have to separate the derivative component and the contract component separately and then recognize accordingly. Similarly, what Vijay is saying is equity and liability combination as well, but liability you recognize based on, yeah, you recognize fair, like you do amortized cost method. You recognize your liabilities in amortized cost method based on the interest rate prevailing, if they have increased or decreased. So your liabilities is recognized on ACM, amortized cost method, right? So all these things that you recognize based on fair value based on fair value, that is your fair value accounting estimate. Example, complex financial instrument, just now what I gave, embedded derivatives. So you have to specifically differentiate the contract from derivatives, embedded derivatives. Similarly, share based payment also, you have to recognize the financials based on the shares that you will be allotting to them, and you have to forecast what will be the value and then discount accordingly during that period, whatever be the amount that you will be giving to the employees or to the holders of the share based payment option. and then you will be discounting it back to compute the value as on date today, and then you will recognize accordingly. Similarly, PP held for disposal, so this has to be recognized in fair value if you remember, Ind AS 105. Then certain assets or liabilities acquired in a business combination, including goodwill, intangible assets. So again, if you remember, in the business combination, we acquire all the assets in fair value, right? So fair value there also you will recognize it in the fair value, and therefore these all are your fair value accounting estimates. Similarly, transaction involving the exchange of assets or liabilities between independent parties without monetary consideration. So here also, if you remember, in India's 16 and India's 116 as well, and even in India's 115, they say that if you are doing a barter transaction, so fair value of asset given up is to be prioritized, and in the case if fair value of asset or given up is not there, then fair value of asset received has to be taken. That is given in India's 16 PP. So they are saying that if suppose I am selling you an asset, I am purchasing you an asset for the consideration. That means asset to asset, say barter, suppose you can say, then we have to recognize the incoming asset, the asset which I am purchasing it from you. I have to recognize it. First priority will be fair value of asset given up, and if the fair value of asset given up is not there, then fair value of asset received will be taken. So that is again what you are taking is fair value only, right? So fair value is again here what, an accounting estimate. Similarly, other than fair value accounting estimate could be those all those transaction relating to provisioning, or suppose depreciation. Depreciation, you must be remember method of providing for depreciation. Is it an accounting estimate or accounting policy? Method of depreciation, SLM, WDV,
Accounting is
accounting estimate. But why? Earlier it was accounting policy, but now it's been classified as accounting estimate back when in 2016. I remember. Why? Method of depreciation is,
because we may change the method of depreciation.
we may change the method of providing depreciation, but yeah, we may change the method of valuation of closing stock as well. But that is a accounting policy. For accounting policy, if you are going to change any accounting policy, then you have to give justification reasons for them, and then you can change. Yeah, it could not be that frequent, but yeah, you can change. Method of depreciation is SLM, WDV, US, you can change, but that does not mean it has to be accounting estimate only. Like method of valuation of closing stock. Yes. Anything that you
So
can come up with.
it, it is estimate because there is no flow of money.
Come again.
So there was no flow of payment or something. That's why it's
There is no flow of payment, no, but what Suneshwaran is saying is correct. It's a systematic pattern of usage, right? So when you are opting for WDV, you are thinking what, my asset will be used more in initial years and less in later years. But suppose if you are opting for SLM, then you are thinking what, my pattern of usage will be equal in all the years. The asset will be used equally amongst all the years. So this usage pattern, what you think and what actually happens can change, right? Just like what you think is should be the provision for doubtful debt, it can change in actuality. The asset could be used more in initial year as compared to what you thought in the case of SLM, that it will be used equally in all the years, but rather it used more in earlier years. So your usage pattern, what you estimate versus what actually happens, could change, and therefore depreciation method is depending upon your pattern of usage, right? And therefore it's an accounting estimate because your usage pattern might change, what you estimate might not be actuality. Okay. So these are all what my other than fair value accounting estimate. Other than fair value accounting estimate may see what all are coming. Allowances for doubtful accounts, inventory obsolescence, warranty obligations. So whenever you make the sales, you expect certain items to come back to you, right? For warranty, for guarantee purpose. So you make certain provisions for these as well, for warranty. Then depreciation method or asset useful life. Provision against the carrying amount of an investment. So again, you make provision for investments that you make, provision for dividend that you can receive, provision for impairment of the investments, right? Long term contracts, there could be certain time, certain um, you can say escalation due to inflation, or escalation clause could be there in the long term contracts. So specifically for those escalation clause, you can start providing for right now also. And the provision that you have started creating from today, it's a what, account estimate, which is other than fair value accounting estimate, because here you are not calculating fair value. Fair value are of those asset liability like shares, or some certain asset like property, plant and equipment when we transferred between each other. So those are fair value accounting estimate, and these are what other than fair value accounting estimate. Just remember the reason, or you can just remember both fair value as well as other than fair value, because they can ask you as well in the MCQ section. MCQ. Now, accounting estimate that give rise to significant risk. So first of all, see the question. What they asked in Jan 21 examination. For 4 marks, they asked for Jan 21. HK and Company was appointed as an auditor of GSB Limited operating in telecom sector. GSB Limited paid the license fee on its core business revenue. So telecoms have to pay license fee. If you know, there was a 5G spectrum case also running last time, whereas government required it to pay on non-core business receipts as well. That means government is trying to say that okay, you don't have to just pay on business receipt, but also on the non-core business receipt. So consequently, the amount of provision was of such a huge amount that GSB Limited's profit and loss account reflected a loss due to that provision. So when we start provisioning based on what government is ordering, what government is asking is you have to give on non-core business receipts as well. So if we consider that factor, then our profit and loss has turned into losses. From profit, it has turned into losses. Now, how you as an auditor can evaluate this accounting estimate, this provision that we made, this accounting estimate, which involves significant risk. Now there is a significant risk because the matter is still there in the code. The matter is still running in the code. Until now, decision they have given. So what if management has not addressed the effects of estimation uncertainty on provisions made? So they are trying you to evaluate this accounting estimate, what effect it could have, and what if management has not addressed the effects of estimation uncertainty? Then what will you do? If the management has not actually evaluated the impact that it will have, it could have impact even in our going concern as well. It can have impact even in our going concern, right? So you have to evaluate. You means management has to evaluate, but you as an auditor also has to evaluate the accounting estimate involving significant risk. And see here, so involving significant risk, the question is coming from where? In the cases of significant risk that could also impact your going concern, or that could significantly turn your profits into losses. These are all what my accounting estimates which involve significant risk, and therefore we have to specifically evaluate. We means here now the auditor has to specifically evaluate, apart from whatever substantive audit procedure that you will be carrying out anyway. Apart from that, you have to specifically evaluate the following. What? Whether the management has considered alternative assumptions or outcomes, why it has rejected them. That means if suppose we were already making provision for 20%, but we rejected it and now made the provision for 10%, then there should be certain reason for rejecting 20% and accepting 10%. So how management has considered alternative assumptions, why they have considered alternatively 10% instead of 20% outcomes, and why reason why it has rejected them. So you have to consider now all this, because this involves significant risk. You have to be sure that okay, the estimation should be motamati approximately should reach to outcome, or even if should not reach, but according to circumstances it should not be any sense biased in nature, biased or unobjective. So that you have to also see that how management has otherwise addressed estimation uncertainty. Important. Do you remember the question last line? If management has not addressed the estimation uncertainty, then what will you do? So you have to also check upon with the management whether they have addressed the uncertainty or not, whether the management has addressed the uncertainty or not in making the accounting estimate. Now whether the significant assumptions used by management are reasonable, whatever assumptions that management is taking up, whether is it reasonable or unreasonable, right? Management can manipulate, just like Avijat told. So it has to be reasonable assumptions, not like apart from the rest of the world, or just going away from the deviating from the industry standards. It should not be like that. And then where relevant to the reasonableness of the significant assumptions used by management or the appropriate application of the applicable FRF, management's intent to carry out specific course of action and its ability to do so. So wherever they are thinking that okay, we are assuming that 10% bad debts can happen, but considering that whatever recovery action that we will be taking in future course of as a future course of action, we should not take 10% but rather take 7% or 8%. So are we confident, is it the assumption is reasonable based on that grounds as well? That also you have to consider. So recoveries should be efficient, right? So whenever you are trying to recover the amount, then your also provisioning can be lower. Similarly your asset quality will improve, because of efficiency and recoveries. Now, if in the auditor's judgment, management does not adequately address the effects of estimation uncertainty, then last point the question was there. Last point the question was there. What will you do if the management has not addressed the estimation uncertainty? Auditor will do what? Auditor will develop a range with which to evaluate the reasonableness of the accounting estimate. So he'll develop a range that, okay, fine, management has not addressed the estimation uncertainty, so we will only do, if suppose management has taken 5% as pfdd, so we will assume that, okay, it will vary from 2% to 8%. We will have a range. We will develop a range with which to evaluate the reasonableness of the accounting estimate. And now with this range we will evaluate the reasonableness, not with the 5%, but rather, if management has already addressed the uncertainty, then management will only give us the range, right? Management will give us the range that, okay, fine, there is an uncertainty involved in this 5% pfdd that we have taken, and it could vary from 4 to 6. But if the management has not provided for the uncertainty and management is not addressing the uncertainty, then we have to develop by our own a range, develop a range. Are we clear? Are we clear? Just go through this once again. It's an important question asked in Jan 21, again out of the box, again out of the blue, nowhere in RTP MTP, straight away in the exam. Yeah, so gone through. Are we clear? It's a complex standard. You have to just imagine the scenarios as well to try to retain the stuffs. So retention is the main issue. Yeah, done or not? Yeah.
हाँ सर, फर्स्ट पॉइंट एक्सप्लेन कीजिए ना, like how management has otherwise addressed estimation uncertainty in making the accounting estimates.
So like management also have to provide for a range, that if suppose we are assuming certain percentage or any other accounting estimate that you are taking, what happens if it, what actually will have the impact if it happens otherwise, that is not based on our estimate, but rather if because of the uncertainty we have to address those uncertainty as well. So management has otherwise addressed those estimation uncertainty or not while making the accounting estimate. So in accounting estimate, if suppose you are trying to say that this point, so we are arriving at that point of estimate is suppose 5%. But now when considering there could be an estimation uncertainty, so you then shifted it to past averages of what actually was the deviation from actual versus what our estimate is, and based on the average of the deviation during the past all the years, you changed what, you changed your estimation uncertainty. Or suppose you checked upon those points as well while making or arriving at accounting estimate, you also checked upon your estimation uncertainty, address those uncertainties as well. Then that is what we have to see whether management has addressed those estimation uncertainty or not. Getting it, that uncertainty element management also has to look for, and then accordingly develop a range. Should be range wise. If they are not developing it, then we have to accordingly develop ourselves. And that is what the last point is also, the fourth point. If they are not adequately addressing the estimation uncertainty that is giving rise to significant risk, then auditor, as an auditor, we have to develop a range with which to evaluate now the reasonableness of the accounting estimate. Now we will develop based on according to past experiences, past what has actually happened, the trend scenario, and the given the outlook our future, and accordingly develop a range. And so if suppose our range is coming out to be 2 to 4%, but management has prepared as per 5%, then we'll simply say that whether the accounting estimate is reasonable or not. We'll then say that no, accounting estimate is not reasonable. If management has not provided or management has not addressed the estimation uncertainty and not developed a range, then we accordingly have to develop a range, because management has not addressed the uncertainties, right? So we will develop a range and accordingly see whether the accounting estimate fits, accounting estimate is reasonable or not. The last point. Yes. Shall we go ahead? Now, what as an auditor, your objective in this standard on auditing SA 540, you as an auditor, you have the objective that whatever accounting estimates that you as the management that they have taken should be reasonable. First of all, accounting estimate whatever they have taken should be reasonable, and all the related disclosures whatever they are made in the financial statement must be what adequate as well. So whatever disclosure requirement is there for accounting estimate purpose, it should be adequate, disclosed properly, adequately presented and disclosed. And similarly, whatever accounting estimate that you are taking should be what reasonable. Now, wrap and related activities. So now we'll go through the structure of the standard. So now the standard is starting actually. So we will do what? We'll perform a risk assessment procedure. Risk assessment procedure will perform and all sort of related activities like we did in all other audits as well, in all other standards. We will in here also for accounting estimate will perform risk assessment procedure, and I particularly told you that because of the degree of estimation uncertainty there will be more of ROMM, right? So we have to perform the RAP, then identify all those risks. After identification, now after identification and assessment of all those ROMM, we have to give responses to those assessed ROMM risks, and then response should also be given to significant risk estimation uncertainty. And lastly, measure and disclosure related to accounting estimate has to be checked upon, that proper disclosure has been taken care of or not, measurement is proper or not, accounting estimate, fair value accounting estimate properly measured and then only recognized, disclosed properly or not in the financial statement. So that is going to be the flow, of the standard, that risk assessment procedure you have to carry out. And in the risk assessment procedure you will see so many points. That means in the risk assessment procedure you will start inquiring about the management, whatever circumstances you took for granted, is there any change in those circumstances, inquiries about the management about the circumstances itself. Then you will accordingly decide whether we should review the outcome of the previous accounting estimate. That means prior period mein jo we did accounting estimate, and what is the actual outcome of the accounting estimate that we did in the last year. And then accordingly also you can realize upon what a current period accounting estimate looks like. So everything has to be seen, and then only we'll do what, complete our risk assessment procedure and risk assess the risk. So let's start with now the important part. First, it says auditor shall obtain an understanding of the following in order to identify and assess the ROM for accounting estimates. So identify and assessing the risk of material misstatement. Identification and assessment of risk of material misstatements for accounting estimates they are trained. So specifically whenever they say accounting estimate, straight away your mind should go to where? SA 540. Now they are saying what? Identifying and assessing the ROMM. You have to take an understanding of certain matters, certain points. You have to take an understanding. But quickly tell me, why are we taking the understanding of the following points for identification and assessing the ROMM for accounting estimate? Why are we actually identifying and assessing? Why? We want ROMM to increase or to minimize? We want ROMM to increase or to minimize? Quickly tell me. ROMM to be increased or minimized? Decreased. We are identifying and assessing the ROMM for accounting estimate, and for that we'll obtain our understanding. So right, then Lakshmi, yes, we have to minimize the ROMM, right? So that is how they frame the question a bit different from what the language says. So language is this only: auditor shall obtain an understanding of the following in order to identify and assess the ROMM. So instead of identifying and assessing, they told what, you definitely you will identify and assess the ROMM, but that is not for the increasing, right? You will be trying to what, minimize the ROMM. So for what the following points you should get an understanding, you should obtain an understanding to minimize the ROMM. So that is what the exam question was: how do you minimize risk of material misstatement when you observe certain material financial statement assertions based on accounting estimates? So accounting estimate they've told, so definitely your SA 540 should ring your bells. So are you getting the focus? I am trying to focus here is what, the question framing part. Definitely the below part is more or less simple only, but framing should be what, you should get to know the idea that okay, we are identifying and assessing the ROMM, and for that we will obtain certain understanding. We'll obtain certain understanding for identifying and assessing the ROMM, but we are identifying and assessing the ROMM for minimizing the ROMM. So they have framed in like that, okay fine, how do you minimize the ROMM when you observe certain accounting estimate? How do you minimize it? So we minimize or we identify and assess the ROMM to minimize it by understanding the following. By obtaining and understanding the following. Everyone clear? Yes or no? If question is clear, then only we will move to answer. What actually are they trying? How, what information have we to obtain to minimize the ROMM? Any doubt? Clear? So see here now. First of all, we'll try to get about the information regarding the applicable FRF. What does the FRF say? Financial reporting framework. What does India say? What does AS say? How do you need to make the accounting estimate? What is the actual requirement? Law. What does the law says? What does the FRF says? First requirement. If they are not actually requiring us to make an accounting estimate, then we may not even do so. So first of all, try to get upon the information regarding requirements of the applicable FRF. Then how does the management identifies those transactions, events, conditions that may give rise to the need for accounting estimate? Now, according to AS India, yes, there is a requirement for us to recognize any such material financial statement assertions which involves accounting estimate. Now, then we have to get upon on the management and ask them, how do you identify those transaction or any event, even in event or conditions that give rise to the need for accounting estimate. So event or condition, I told you, example could be what? Depreciation, right? So depreciation, even if it's not a transaction, but that could give rise to the need for accounting estimate. So you have to inquire with the management. How do they identify, how do they identify the transaction, events, conditions which may give rise to the need for accounting estimates? And then the estimation making process, how do you actually make the estimation making process, how, what is the exact process, how do you make the estimate, how do you arrive at 4% PFDD, how do you arrive at certain amount, the estimation making process adopted by the management, you have to go through them, walk through the process. And for that you will see what the method which is including applicable, the model used. So suppose dividend discount model is used, or you are using free cash flow method approach, free cash flow, so whatever method that you might be using. Similarly, if you are using the free cash flow method or dividend discount model or any sort of assumption for calculating what? Fair value of share. Example, let's say fair value of share we are calculating. So you will be also making assumptions for free cash flow. Suppose for last year, last 3-4 years, you will see revenue. What is the last 3-4 years revenue? And accordingly, you will see the CAGR, CAGR. That means this divided by this. If suppose in 2018 it was 120, and in 2023 it is around 221. So how do you calculate CAGR? That is compounded average growth return. 221 divided by 120 to the power 2018 to 19, 20, 21, 22, 23, 5 years in between. So 1 by 5. We will arrive at what? CAGR, right? So see this CAGR, we will now forecast our revenue next year according to CAGR, right? Or even if you can take the last year increase, how much is it? It is it 20%. So you can increase with 20%. So whatever assumption you are trying, that also you have to see all the controls on those methods, DDM assumptions, controls, internal controls, and whether management is using any expert for all this process, to carry out all this process, to carry out accounting estimate. Like in the case of, do you remember SA 500, expert, actuarial, for the purpose of employee expenses, right? For the purpose of employee expenses, gratuity, PF. So whether the management has appointed or used an expert for all this estimation making process, and how the management has assessed the effect of estimation uncertainty. Again, same point. So I hope you are getting to get the grip of the estimation making process. It's very simple. You have to walk through the process. So estimation we have to make. So definitely we'll need to forecast. So for forecast, I'll need what? Assumptions. On what assumption I'll forecast, right? So assumptions. Then methodology. What exactly is my methodology to arrive at the value? So it could be DDM, it could be free cash flow approach, free cash flow equity, or a relative approach, and ROMCOM. Any could be. Not sorry, ROMCOM, but comparables approach, comps method, we say comparables approach. Relevant control, where management has used an expert or not, that you'll also evaluate whether management has used any expert. Relevant controls that they're imposed upon them. And lastly, have they estimated the effect of estimation uncertainty? So that is your walkthrough of the estimation making process. Again, they can ask you for 4 marks. Estimation making process adopted by the management, how should you evaluate, what all points you will consider. And now lastly, we will review the outcome of the accounting estimates included in the prior period financial statement. I told you, do you remember? For the current period financial statement, whatever is the accounting estimate that you are seeing, you'll also check upon with the management that how they have assessed in the prior periods, how they have assessed the accounting estimates. And management cannot deny. There is a question RTP question, RTP 19, which I was telling that okay, fine, this is been asked in RTP and this can come, whether management can deny. If not, then what is the responsibility of management, what is the responsibility of as an auditor? And the same question, exact same question, pop up in this attempt. So auditor shall review the outcome of accounting estimate included in the prior period financial statement, and management cannot deny so. And that is what we will see here. RTP question. See, let's just directly come to next page. Sorry, next page. If you can come directly to next page and see the question, RTP May 19 question and May 23 exam question. Just go through the question. See here, management refused since those accounting estimates relates to prior period financial statement. So what does management opines? Management is of the opinion that why do you need prior period financial statement information? Those are closed, those are completed, fine, done, go away. Not required to go with what? Prior period financial statement figures. You are here for current period financial statement, ask for them, not for prior period. So discuss. So I'll only we identify and assess the ROMM also whether to apply the FAP. Yeah, substantive audit procedure will be applying, but here we are specifically seeing that apart from substantive audit procedure, how do you actually will respond? Apart from that, substantive audit procedure definitely you will apply test of detail of transaction, and then your analytical procedure as well. You will apply them, but apart from that, specific about whatever be the case for accounting estimates, we are trying to address those here. So review of outcome of accounting estimates. Quickly tell me, fatafat say, what do you think? What will you as an auditor get help when you review the outcome of the accounting estimate? That means how do you will get the benefit out of reviewing the outcome of the accounting estimate? How is it benefiting the current period financial statement audit? Hmm? See, management is refusing that they won't be providing you with the prior period financial statement information regarding accounting estimate, but you have to convince them that how will you get benefited from this. And even the standard requires, so it doesn't matter whether management sees the benefit or not, they have to provide. It's a standard requirement. So what do you think, you all? Hmm? What are we doing here? We are actually reviewing the outcome of the prior period financial statement ka accounting estimate. So prior period financial statement, suppose you stood 5% for provision. Now the outcome is suppose 2.5%. Actual outcome of the prior period financial statement accounting estimates. So what do you think? Why are we doing this?
About management assumptions like estimation,
Get an idea about management
correctness,
assumptions,
their correctness of doing work.
correctness of their working, how are they actually estimating accounting estimate balances. Yeah, anything else?
Whether there is uncertainty in like um, assumption.
Whether there is an uncertainty. So how will you get the information from reviewing the outcome of the prior period accounting estimate?
Like law says it's 20% depreciation, but they have charged 21% depreciation.
Okay. No, we are not seeing the what they have provided for. We are actually seeing what they provided for versus the outcome of that provision. So we are actually reviewing the outcome of the provision that they did. So outcome during the prior period financial statement. So
Yeah.
kind of trend analysis, past trend, yeah, correct. So you will get to know
Addition.
what is the impact on the current period estimates. So accounting estimate that has been made current year, you will then get to realize that okay, how much is the management correct all the times, how far is the management correct during last provisions that they have made. Similarly, you can analyze what could be the estimation uncertainty that could arise, right, because of which your ROMM can increase. So that is what they are saying, that auditor shall review, has to review, shall review the outcome of accounting estimates included in the prior period financial statement, or where applicable their subsequent re-estimation as well. If suppose in 2018 they estimated and in 2019 they re-estimated, so subsequent re-estimation also have to be checked upon. And then the nature and extent of the auditor's review takes account of the nature of the accounting estimates and whether the information obtained from the review would be relevant to identifying and assessing the ROM of accounting estimates made in the current period financial statement. So they are linking it with current period financial statement. Whatever um, review would it be relevant for identification and assessment of the ROMM of accounting estimate in the current period? Will the review outcome that you carried out for the prior period financial statement, will it be relevant for us in the current period financial statement as well? But yeah, it could be relevant. If you are finding a major deviation, then you can also project the same for the this year for the current period financial statement as well. You can ask with the management can revise the same, revise the accounting estimate. So that all you have to check upon. However, the review is not intended to call into the question the judgments made in the prior period. That already I have told you. Then Lakshmi, do you remember? Review, we are not reviewing. We cannot judge that the estimates that they have taken is wrong. It is not the case of misstatement. Estimates could be there based on certain conditions that prevail during that period. However, the outcome could be varying. Outcome could vary, right? And that is what they are saying, that we are not intending to call into the question about the judgment that you have made. We are not telling that you made the wrong judgment, but we are just trying to assess that how much deviation it could happen. We have to develop our own range, right? Get our idea about our estimation uncertainty, your estimation uncertainty. So that is why we are reviewing it. That is why we are reviewing it. It is not for intending to call upon the judgments that you made in the last year. It is not like that. We are not going to question upon the judgments. And then also you'll say the outcome of accounting estimate will often differ from the accounting estimate. Yeah, definitely. We are not god. Accounting estimates and the actual outcome of the accounting estimate definitely bound to vary in the prior period financial statement. Whatever estimate you make and the outcome bound to vary, right? So by performing this risk assessment procedure to identify actually and to understand the reasons for such differences, auditor may obtain any information regarding the effectiveness of the prior period estimation process. So they can ask with the management, how much effective are you? What is the past like the trend? How much effective are you? Similarly, they can inquire with the management, talk to them regarding how comfortable they are with this accounting estimate. And then similarly, audit evidence can be obtained relating to re-estimation. If they are re-estimated, then also you can check upon why they have done the re-estimation, what was the reason for that, and what now is the new figure versus what was the earlier. Similarly, audit evidence such as estimation uncertainty that may be required to be disclosed in the financial statements. Now, last point important, the review of prior period accounting estimate may also assist the auditor. It will also assist the auditor in the current period in identifying those circumstances or those conditions that increase the susceptibility of accounting estimates or indicate the presence of possible management bias. That means what? You can now think that okay, fine, management is generally trying or generally are biased. So from the past prior period accounting estimation and judgment, you can see what, yeah, okay, it can be so that they are susceptible to losses, or they are in the presence of management possible management bias. Accounting estimates, any other sort of review can be because of there could be a possible management bias as well. And similarly, lastly, auditors professional skepticism has to be there. That is why, how, who. So again, if you try to revise this answer, it's an important answer that also asked in this attempt, might not again be asked, but again it's an important for you to also for MCQ as well as for answer. Definitely 5 mark question came this attempt. So auditor will first of all review, right? Review the prior period financial statement, whatever judgments you provisions you provided for, and the actual outcome, and any subsequent re-estimation you did, there also you will assess that. And then they say that whether the information that you obtain from the review, is it relevant for our current period financial statement. Whatever information that you obtain from the prior period review, whether is it relevant for our current period financial statement, yes or no. And then you will say what, we are not here for judging you with respect to the prior period estimation making process. No, we are not judging. We are not here to judge or not want to call upon the judgments that you made earlier year, but we are actually here to see the deviation differences, why the case between the same, and accordingly develop our level of estimation uncertainty. And the outcome, we are also we are also agreeing that yeah, definitely outcome will differ every time it will differ. However, we have to understand that how much effective your management estimation making process is, and for that matter we will review the outcome of your accounting estimate. For reviewing the accounting estimate, that means what, we are actually trying to assess, right, how much effective management is in their estimation making process. That is the basic answer which you should have told when I asked why do I review your results, why do I suppose review the outcome of certain expectation. So you expected something and then you review your outcome. Why do you do so? So that you have to check upon whether you achieved what you estimated, whether you are effective or not, whether you are effective or not. So that is what it says. Outcome of the accounting estimate will often differ, but we are here to understand the reasons for any sort of differences and also obtain the information regarding the effectiveness of the management's prior period. And lastly, review has to be done so that you are also aware about any possible management bias that could be there, which you will see in the last page of the standard indicators of possible management bias. And also you have to be all the time open up your mind. Professional skepticism, everything has to be followed. Just go through once again. I'll tell you, just we revised it twice. I want you to again give it a reading and try to imbibe upon. First 3 points are simple, and then there comes the outcome will differ vary. Outcome will vary differ from accounting estimate. Why? Because of information and why are we actually then trying to assess the outcome? Because we know, then if we know already that yeah, definitely it will vary based on accounting estimate, then why are we actually reviewing that outcome? Because we want to assess what management's effectiveness of the estimation making process. Audit evidence we have to calculate collect regarding re-estimation making process, and then audit evidence regarding uncertainty estimation uncertainty, right? Just go through this once again, and then we will resume from our risk assessment procedure. We have completed A B C D 4 points, completed entirely almost your risk assessment procedure and related activities. Chalo then. Estimates with low estimation uncertainty and estimates with high estimation uncertainty. So we were going through high estimation, or we were going through estimation uncertainty, right? So accounting estimate involves estimation uncertainty, that is for sure. So whether is it low estimation uncertainty or high estimation uncertainty, so you will only be able to answer me quickly, fatafat se bolo. What do you think if suppose the accounting estimate, whatever model, suppose we are using FCFF or any other model, DDM, whatever model we are using, it is well known model or it is generally accepted model, what do you think, estimation uncertainty will be more or less? Bolo.
Less.
Less, right? If would have been not known by everyone, then it would be more. Estimation uncertainty would be even more because the model is not known to us or not known to everyone. Then similarly, the inputs that you have in the model are observable inputs or not. So India's 113, if you have done or not done, I don't know, but there is a concept of level 1, level 2, level 3 inputs. In India's 113 fair value accounting estimates, you will see level 1, level 2, level 3 inputs. And even in the case of investments, you will find that the investments have to be specifically classified, that how much investments have you valued based on level 1 inputs, how much investment have you valued based on level 2 inputs, and how much investment have you valued based on level 3 inputs. What exactly are level 1, level 2, level 3? Is level 1 is similarly directly from market data. Suppose example, share price. So you directly take the share price of that entity, that is a level 1 input, that is observable input. Similarly, level 2 is not that observable, however you take price of similar entity or price of similar unit, price of similar product, price of similar unit or similar entity, and therefore that is a level 2. However, it's not exactly level 1 because we are not taking the price of debt itself, the entity debt itself, so that is not as observable as L1 is. L1 level 1 is best. And then level 3 is what? Level 3 is our, when we are not able to get any sort of market information, then we are applying what, DCFF or DDM. Based on past figures, we are then trying to project and then accordingly pull all the discount all the figures and accordingly arrive at an enterprise value or enterprise value. After that enterprise value, we will deduct what, debt, and we'll get what, equity value, and that divided by number of share will get what, share price, right? So this is what my level 3 input, this is what level 3 input, all the assumptions that I took is our level 3. So if the inputs are observable, that means what? It is either level 1 or level 2. It is either level 1 or level 2. So what do you think? It will be more or less? Which input you should have, level 1 or level 2 or level 3 in your estimation making process? Patafat. Level 1,
Level
right?
1.
Level 1, try. Level 1, level 2 are more less estimation uncertainty will be there. Similarly, accounting estimates arising in entities involved in business activities that are not complex. So business activity, if it is complex, then definitely estimation uncertainty will be there, but estimation uncertainty will be less if they are not so complex business model. And then if they relate to routine transaction, suppose PFDD or any other routine transaction, whatever estimates is there, then definitely the estimation uncertainty will be less. However, now we have to make provision on, suppose example, you have made investment in crypto, and now you have to impair or provide for the impairment of the crypto, that investment that you made. So this is altogether a new transaction, right? It's not a routine transaction, and therefore the estimation uncertainty will be high in that case. Accounting estimates derived from data that is readily available, such as published interest rate data or exchange traded price of securities. Such data may be referred to as observable in the context of fair value accounting estimate. They are trying to just give you an example of observable input. If you would remember, we could directly take interest rate from RBI website for us to actually value. So whatever value that we certain times do is based on what? Interest rate. We pull the figures, right? We discount the figures based on interest rate. That means cash flow 1, that is cash flow 1 in year 1 divided by 1 plus R1, right? Similarly, cash flow 2 in year 2, whatever be the cash flow, it is 1 plus R2. In year 2, what will be the rate? Similarly, cash flow 3, 1 plus R to the power square हो जाएगा ये, and right, similarly 1 plus R3 to the power cube. So that is how we do pooling, discounting. So that is what they are saying. The interest rate that you are taking is, suppose, is observable. You are taking the market interest rate, the interest rate that is quoted by RBI treasury rate, then that is all what? Observable inputs. However, when you are trying to compute your imputed interest rate, right? Imputed interest rate, you might be aware about this. In leases we do Ind AS 116 imputed interest rate. So there it could be what? Non-observable inputs, and non-observable inputs are high estimation uncertainty will be there. And lastly, fair value accounting estimates where method of measurement prescribed by applicable FRF is simple. That means what? FRF itself recognize the measurement method. How exactly are you going to measure the accounting estimate? FRF itself tells you, like in the case of Indias, right? So 113 itself tells you how do you actually calculate the fair value. So where the method of measurement is actually provided for by the FRF itself, then that will also involve what? Accounting estimation uncertainty as low estimation uncertainty. I hope everyone is clear with this, but we also have to learn all the points, because this can be asked for 5 marks straight away. This have not been asked. This was asked for 4 marks involving high estimation uncertainty, but this has not yet been asked. So can be asked. So let's just try to learn. Imagine a model mean here means what? Fashion wali model. So if you remember, वो सांधू 2021 Miss Universe, Hardeep Sandhu, Harneet Sandhu was there na, in she became Miss Universe in 2021 from Indian origin. So that kind of model you imagine, and she was just going from her complex, and we started following her route, right? So I started following her route, and along with me many others also started observing her. And then we did what? We just directly measure her performances, and told her to have a photo frame with us, told her to have a click or pic with us. So that is what you can try to recall all the points. Model here means what? Model exactly is our first point. Observable or not? Model is observable or unobservable model. Similarly, complex means what? Complex transaction, or not, sorry, complex business वाला था ना. Business activity is complex or not? Complex is business activity. Complex business activity or non-complex, right? Then routine transaction. Then observe. I told you what? Everyone started observing. Everyone started observing her because we all wanted to have a photo with her. So observe, it was observable inputs. Observable inputs. And then measure करके उस पे financial photo frame. So photo frame, you can say it for financial reporting framework, financial reporting framework. Whether they itself allows you measurement method. Measure means here what will be what measurement method. Whether the measurement method is prescribed by the FRF. Are you getting it? So all the points have to be gone through, because they can ask you directly. Any doubt? You can also go through this high estimation uncertainty as well. It is more or less in the same lines, but this is the opposite of low estimation uncertainty. Exam question, I have given it in the side. So quickly go through that exam question as well as that factors or degree of estimation uncertainty when it will be high estimation uncertainty. Fatafat. Yeah. So come to factors involving in sorry influencing degree of estimation uncertainty. So what we saw right now was whether is it high estimation uncertainty or low estimation uncertainty, but what factors actually influence whether the estimation uncertainty will be high or low. So definitely any sensitivity of the accounting estimate to any sort of changes. So if suppose interest rate changes even by 1%, then if you are pulling the amount, right, discounting the amounts, then it will have a significant difference if the amount in the last years are more. So if the amount in the last years are more, then it will have a significant difference. Just wait. Yeah. So what I was telling is what factors can influence your degree of estimation uncertainty, right? So the first one is the sensitivity. Sensitivity, what I was telling is suppose you change 1%, and if the cash flows are in 10th year, 12th year, 15th year, so that will significantly impact your present value. Present value when you compute. So even if you increase or decrease that interest rate by even 1%, then that will also significantly impact your present value. So that is what they are saying, sensitivity of the accounting estimate to changes in the assumptions. Similarly, the extent to which the accounting estimate is based on observable or unobservable inputs. So accounting estimate, like I told you, whether is it based on more of level 1, level 2 inputs, or is it more of level 3 inputs, right? So if it is based more on level 3 inputs, then that what will happen? It will kind of have high estimation uncertainty. And then length of forecasted period, you only tell me what do you think 3 years forecast and 10 years forecast, where do you feel that length or estimation uncertainty will be high, 3 years or 10 years? And the relevance of data drawn from past events to forecast future events, where do you think 3 years or 10 years?
Years,
Huh?
10
10.
years.
10, right? Why? Because the more the period, the longer the period, the more difficult it becomes to forecast. Actually, we don't know whether any another COVID will happen after 10 years. Yes. Yeah, right. So we don't actually know more. If we elongate the forecast period, then recognize measurement technique existing or not, so which may mitigate the estimation uncertainty. So you have to check upon the existence of recognized measurement technique which may mitigate the estimation uncertainty. So if your FRF only recognize the any sort of measurement method, or they only tell you how exactly are you going to measure, then that is good. But if it does not exist, then the estimation uncertainty will be high. Similarly, reliable data, is it available or not from the external sources? If it's available, then it will be low. If it not, then estimation uncertainty will be high, and the extent to which accounting estimate depends upon your judgment. So again, the points are easy, but let's try to also learn all the points. So I kind of made a trick to remember. So it's kind of a movie, if you remember, if you all have seen that movie. So let's not go into that movie, but it's kind of same. So matter is very sensitive, and our judge in the Supreme Court, judge had observed this matter very minutely, and because of which the length of period has increased. Tariq pe tariq, tariq pe tariq. So that has increasing, postponing. So length of period has increased. We measured that length. Now this length, we measured this length. And finally, reliable data from all the external sources. From all the external sources, we provided our judgment. That is, judge provided all the judgment with the reliable data from all the external sources. So matters sensitive. That means what? Sensitivity of the accounting estimate. Sensitivity, first point. Then judge ने बहुत जज ज़्यादा ऑब्जर्व किया. ऑब्जर्व इज वेदर द इनपुट्स आर ऑब्जर्वेबल और नॉट. लेवल 1 लेवल 2 वाले या लेवल 3 वाले, राइट? ऑब्जर्वेबल इनपुट्स और नॉट. Then length of period. So forecast period. Measure किया length. So measurement से measurement techniques. Measure से measurement techniques. Yes or no, everyone? Measure से measurement techniques. That is your fourth point. Then finally, reliable data. Reliable data here will be what? Fifth point. External source. Yeah, final reliable data from external source is fifth point. Judgment will be what? Your last sixth point. Extent to which accounting estimate depends upon the judgment. So all the points are covered. If you go through this, it's very not that difficult also to remember, because it's simple. That it says what? Matter was very sensitive. So judge had observed to a greater length very minutely, and because of which तारीख length of periods increased. And now we measured the length, and based on the reliable data from external sources, since it was very long since the decision was made, based on all the reliable data from all the external sources, we provided the judgment. Right? Any doubt? So now we have done all what? Risk assessment procedure, and also identify the risk, high estimation uncertainty or low estimation uncertainty. Now we will respond to the assessed risk. Response to the assessed risk. So whatever risk that you assess, now you will respond by seeing what whether management has appropriately applied the applicable FRF, and whether the methods are appropriate and have applied consistently. So what they are trying to say here is we have to respond also to the assessed risk, and also response to the significant risk where estimation uncertainty will be high, right? So based on the assessed ROMM, you will determine what whether the management appropriately applied all the framework as per applicable FRF or not, and whether the methods that you used to recognize for measuring the accounting estimate, all these are appropriate and have been applied consistently or not. But based on the significant risks, you have to specifically see what we have already covered. Do you remember the first question, Jan 21 wala attempt, whether the management has considered alternative assumptions and why it has rejected the original assumptions, and whether the significant assumptions used by the management, those are reasonable or not. Any assumption, significant assumption, those are reasonable or not. And if in the altered judgment management has not adequately addressed the effects of estimation uncertainty, the auditor will have to then develop a range with which to evaluate the reasonableness of the accounting estimate. Jan 21 question. Now lastly, measurement and disclosure, because the objective. So do you remember the two objectives of SA 540? The first objective was whether the accounting which is being there present in our financial statement, it should be reasonable. And second estimate was all the disclosures that we made should be adequate. Disclosures for accounting estimate should be adequate. So management bias, auditor's responsibility. Particularly, we have to now look for auditor have to obtain all sufficient appropriate audit evidence regarding all such disclosure and accounting estimate are both the objectives of this standard. Similarly, for any sort of accounting estimate which is giving rise to any significant risk, we'll have to check upon the adequacy of the disclosure, whether the disclosure is proper or not. You can go through this management bias and auditor's responsibility with respect to all this. The last point just come to here, indicators of possible management bias. So how do you think management bias can arise in accounting estimate? Anywhere you feel that management can be biased in accounting estimate, where do you feel, or what do you feel that this can be an indicator, this can indicate me that yes, management was biased?
To the management.
Any estimate which provide benefit to the management.
Ah,
That can be an indicator, correct only. Okay, and think. Yeah, the first point what you said is correct only. Now the point which you thought and told and spoke, therefore you will not forget this if the question comes, right? So that is why I want you to try first, try think first, speak up. Even if it's not there, that is also fine. We can discuss on that point. Yeah. Any example which you can think of?
so management can be biased in preparation, presentation of financial statement.
Can be biased in preparation and presentation of financial statement, but how exactly is it indicating a possible management bias out of accounting estimate? From the accounting estimate, how exactly are you getting in the indication that management is
Okay,
biased? We have to go for any sort of point from which we are that is that point actually is indicating that okay, management is biased
okay.
and can be biased.
So selection of significant assumptions
So assumption, selection of significant assumptions.
which
Yeah,
are
you can
favorable to the
say,
management.
yeah, that that's what Avija also told. But you can also mold that into where you are selecting those assumptions or which is different from what industry practice, right? So you can say whatever the industry. So your judgments or your assumptions are different from what industry practice is, or you have made your own assumptions. You have made your own assumptions, or is it inconsistent with your normal industry practice, normal observable input? So interest rate you are taking is 10%. However, interest rate from the market rate of interest, if you say it's 7%, 8%, then that is significantly different, right? So you have made your own assumption, but that is not inconsistent, but that is not consistent with the observable marketplace assumptions. So that could be one point. See the second point, use of an entity's own assumptions for a fair value accounting estimate when they're inconsistent with observable marketplace assumptions. So whatever inputs, assumptions that you feel that you are receiving, and now that you saw those assumptions, and when you try to compare it with the market assumptions, you found a difference, inconsistency. So that could indicate you a possible management bias. Similarly, first one is changes in any accounting estimate or the method for making any accounting estimate where management has made a subjective assessment that there is a change in a circumstances. So I think we missed this question, inquiries of management about changes in the circumstances. But here exactly what they are trying to say in the first point also is that where you already assessed yourself that yes, there will be changes in the circumstances or there will be changes in accounting estimate, and if there is a significant change in accounting estimate method for any changes in any sort of accounting estimate, then you have to see that whether management has made objectively, assessment is made objective or subjective. So subjective means without any data, without any reliable source of information or data points, quantifiable points are not there. You are making your qualitative adjustment based on economic environment, based on industry requirements, right? So that is how you can also determine that okay, management can be biased. And lastly, where you are seeing a pattern of optimism or pessimism, because whenever you feel that okay, whenever management wants to increase their profit, they wants to decrease their provision. Similarly, in the case of pessimism, they will increase your provision. So that is exactly how they are trying to do a point estimate that may indicate a pattern of optimism or pessimism. So these are the 4 points which can be asked now, which can be asked. In this attempt, they asked this one question which we left, inquiries about changes in the circumstances. So we have to inquire with management regarding the circumstances and regarding the changes in the for any sort of accounting estimate, their accounting estimate what management has came arrived at must be based on what certain circumstances, prevailing conditions, right? But if that circumstances itself changes, then don't you think the accounting estimate will also change? So the circumstances what entity felt during the COVID time, what they might have provided for during the COVID time, what they will provide now will be different, right? So we have to inquire with the management whether there is any changes in the circumstances, right? So example, the terms of transaction that give rise to accounting estimate have changed. Example, already we were providing 30 days credit to our debtors. Now we are providing 90 days credit. So don't you think our provisioning will increase? Provisioning will increase, right? We have extended the length of period of credit that we provide to our debtors. Terms of transaction that give rise to accounting estimate, now they have changed. So definitely it will impact our accounting estimate as well, right? Therefore, we should inquire of management about any sort of changes in the circumstances. Similarly, go through other 3 points as well. Just go through it once. Then the second point is entity has engaged in any new type of transaction. So I just like the example that I told, generally we were investing in shares. Investing in shares, now we started investing in cryptos. So this is altogether a new sort of investment, new type of transaction, which may give rise to significant rise in the accounting estimate. Similarly, new conditions are given in the contract or new events have happened, economic environment improved or changed or deteriorated, whatever it could be, right? That can again give rise to revised accounting estimate. And lastly, accounting policies relating to accounting estimate have changed as a result of changes to the requirements of the applicable FRF or otherwise. So suppose example could be what? Your Ind AS 116 when it came. So leases, earlier it was what? 17. But when Ind AS 116 came, applicable FRF, so it provided for a different approach. A different approach in the sense what? Lessee will have to provide always for financial lease only. Operating lease was not there, right? So unless a specific circumstances, there were 2 3 exceptions. But yeah, your accounting policies relating to any sort of accounting estimate, whether they have changed because of changes in the requirement of the FRF. So this will all you have to inquire, na? Inquire with the management. Inquire with the management about changes in the circumstances. So we, in essence, we have gone through the entire standard 540. If you want, we can just go through this also. Just give it a reading right now only, because if I give it as homework, you might leave. Just give it a reading and we'll go through essay 540 from tomorrow then. Class will be from 8 a.m. tomorrow, for tomorrow, Sunday. Yes, go through right now only. Auditor's consideration in assumptions used by management. So whatever assumptions management has used, you have to now also consider those assumptions whether they are relevant or not. So what all matters as an auditor will you consider in obtaining an understanding of the assumptions underlying any accounting estimate. So example they have given, the nature of assumption you will see, how management has assessed the assumptions are relevant for this particular case or not, or particular prevailing conditions. How does the management determine that the assumption should be consistent also? It should not deviate internally. So see, if you are aware about this point, then definitely if at all it comes in the question, then you will be able to answer, right? But if you're not aware about the answer or topic itself, then you will feel that okay, it's out of the box question. Anyway, as I told you, we have not included all the questions. Still, what I feel that they can ask like the questions like this, then that I have included. And if you give it a reading or so, you will be able to recall at least 3 4 points, right? Similarly, auditors consideration in testing the model. So suppose you are using free cash flow approach or dividend discount model for valuation of share. Now you have to test the model. So what, as an auditor, what matters you will consider in testing the model. So whether the model is validated prior to the usage or not, that means it should be automated. Whether the model is used by others, whether the model is already validated. Are you using Black-Scholes model or are other using black model for calculation of derivatives, derivative Black-Scholes model, binomial model, black model? There are so many other models. Or are you using your own model, something other model which you have made in your own Excel? So model has to be validated prior to the usage. Whether is it validated or not, you will also consider whether the model is theoretically sound or not. Like Black-Scholes model is very theoretically sound. Mathematically, integrity, everything has to be checked. Consistency, completeness within the model inputs, all the market practices, whether everyone is carrying out their inputs with the same model. Model's output is actually the arriving, are is it consistent with the actual transaction or not? So if suppose based on Black-Scholes model, you derive at the options price, option की pricing. If you know, even in SFM you have Black-Scholes model, right? So you derive the put option, call option price based on Black-Scholes model. Now you will check whether the option price which is actually prevailing in the market, is it actually consistent with it or not. Then any change control in policies and practices. Periodically calibrated. Calibrated means what? Any changes that is there in the model, formulas, or environment, or any sort of new condition event, everything has to be calibrated and tested accordingly again. So all this point I'll have to see as an alter whether the management has done this or not. For testing the model that is used by the management, I'll use whether the model is documented properly or not. Any sort of adjustment in the output after the model's input. So if say suppose we in here where I'm working, we derive the rating of the entity. So after we derive the rating of the entity, suppose triple B, based on only the financial figures. So we run a model, we based on a model, we input all the figures based on all the disclosures and financials. We arrive at a certain rating. Now after that rating, we also adjust plus one minus, not upgrade or downgrade. We upgrade or downgrade based on financial performance of the entire industry, economy performance, management, how is the management operating effectively or not. Based on every all other factors also we have to consider, which is not yet considered in the financials. So any other adjustment that you are making in the output of the model to arrive at certain output or actual transaction, that also you'll have to see whether all the adjustments that you are carrying out, is it proper or not. So example I gave you, rating example. So you arrived at a rating based on financials only, but now even after the financials there are certain other matters also which have to be considered in your rating, right? So triple A, if you are arriving at triple A, now based after that adjustment, like economic environment of the India is developing, it is not that growing as compared to other. So not for India, but you can think of Sri Lanka or Bangladesh, where it's already degrading day by day. Bangladesh, they have only foreign currency 14 days left. 14 days of foreign currency is left for Bangladesh. If they stop inflowing and outflowing, they will exhaust all their foreign currencies, foreign exchange, in a fortnight period. So that is exactly what our situation was in 1991. If you remember, when Manmohan Singh was then made the FM, finance minister, right? So the kind of situation prevailing in the Bangladesh now, IMF has come for help. IMF has come for help for Sri Lanka as well. So the situation is deteriorating day by day. So all these adjustments, this is just the one adjustment. Similarly, any diversification adjustment, any management adjustment, how equipped the management is. So all these have to be checked, and accordingly we will then consider these matters for testing the model. I hope it's very simple. Only if you just give it a reading, you will be able to write at least few points. You should not skip at the end. So SA 540, as I told, is an important standard. They asked 2 questions this time. So we have given entire class for this. SA 540, please revise accordingly. And what is the position of test? Only I received test of Dhanlakshmi, I guess. Ratio of normal loss is more. Okay, that was earlier. Yeah, I was telling about test. Anyone who has not given test till now, please give it the test, because tomorrow I'll be discussing anyway. So if you have not attempted, it will be your loss that you will be discussing the answers with me without even giving the test. So give the test right now, revise chapter 3, chapter 4 again. It will hardly take 1-2 hours for you, and then attempt the test. And as I told, all the important points which I told in the lecture, that this I feel it can come as an exam question, this has not yet come, those questions I have put in the test itself. So please give right now, today only, because tomorrow morning we will discuss the test. ठीक है?